What is up, everybody? It's Shaun here, and welcome back to my channel, or welcome if it's your first time. Today we are talking about how to invest like the 1%, using a term or strategy that's known as buy, borrow, and die. This is a really cool strategy that the ultra wealthy people use to basically continue to keep building wealth by avoiding paying taxes. This is not going to be a video on whether you should or shouldn't pay taxes, what is ethical, what's not. This is simply an insight into this particular strategy. Then I'm also going to kind of share how you can do a very similar thing, because I think one of the common misconceptions is only wealthy people are able to reduce or minimize their amount of taxes, when in fact there are a lot of strategies that every single person can do. Now be sure to stay to the end of this video, because I am going to share a few things to look out for when utilizing this strategy, and I'm also going to share, in my opinion, what's one of the best ways of getting that portfolio loan at a really cheap rate. If you haven't done so already, please be sure to smash the like button. Hit the subscribe button as well. It'd mean the absolute world to me. And also a little notification bell so you can get more videos on everything money, investing, entrepreneurship, and creating financial freedom, life on your terms. So the term buy, borrow, die is actually a phrase that was coined by a guy named Ed McCaffrey, who in the 1990s was a law professor at USC. And he created this term or this phrase as a simple way of explaining to his students how the ultra wealthy people in the US take advantage of the US tax system by not paying taxes or avoiding taxes. Now, just this past year, a nonprofit organization called ProPublica did a study and found that the 25 richest people paid little to zero federal income tax. For example, from 2006 to 2018, they found that Jeff Bezos had a net worth increase of $127 billion with a reported income about $6.5 billion. Now, while he did pay $1.4 billion in federal taxes, this only came out to about 1.1% of his true effective tax rate. This is much different than the average American, who pays at least 14% or more in taxes. So what does this mean for you? Well, taxes are really the biggest expense that every single person has. In fact, according to this study, they found that the average American is going to pay $525,000 over the course of their life, which comes out to a little over 34% of their overall income. And in 2018, the IRS published a study where they broke down certain income ranges, how much the average tax was paid in that income range, and how many people paid in that income tax. And what they found is that the average American paid a little over $15,000 in taxes. Now, when you looked at the most common average gross income, which was around $50,000 to $75,000, it means that the average American is paying around $4,600 a year in taxes. So while $4,600 a year doesn't really sound like a lot of money, it really can make a huge difference in overall net worth increase. Let's say that you pay on average $4,800 a year, just to make numbers easy, which comes out to about $400 a month. But let's say somehow you've managed to not pay any taxes from the age of 25 to 65. And let's say that you took this $4,800 a year, or basically $400 a month, and invested it in an S&P 500 index fund, giving you an average of 10% return. Well, if you started with $0 at 25 and every month put in $400 from 25 to 65, got a 10% return, you would have $2.5 million by the time you were 65 years old. So while this video, once again, is not about whether you should or shouldn't pay taxes, I do want to dive into the buy, borrow, die strategy, how it works, and how you can help minimize some of your taxes. That way, you can continue to build wealth and financial freedom. So the very first step in the buy, borrow, die strategy is to buy. And this is just like the name implies, you're going to be buying an asset. Now remember, an asset is simply something that appreciates in value over time. And so there are a lot of assets out there, but usually when it comes to this strategy, we're looking at either real estate or stocks. Now when it comes to real estate is one of the most common ways of doing this, because over history, real estate has a really good track record of appreciating, at least keeping up with inflation. It's not a super volatile asset, which that will be important as we get into the next step. Or you can simply buy a stock, and you can either buy single stocks or funds. Typically, I would say you'd want to stick more with funds, because if you have the right fund, once again, the volatility will not be as dramatic as sometimes high growth stocks and things like that. But you want to find a stock or real estate or a fund that appreciates in value over time. So the second step on this strategy is to borrow. And the idea of this is that you're going to use your assets as collateral to get a loan to live off of. And the reason this works is because you don't pay taxes on debt. When you take out a loan, you're essentially taking on more debt, and debt is not taxed. Earned income or realized income is taxed. So the common thing that most people do is that if they own some real estate or stocks and they need to come across some money, they will sell some of their assets in order to collect some money. However, what the wealthy people do is that instead of selling their stock, they actually get a loan against their stock or their real estate. And so instead of paying 20, 30, 40% in taxes, you could get a loan against your asset and only pay a handful of percent in interest on that. So when it comes to real estate, let's say that you bought a house for $250,000 and now a few years later it's worth $500,000, meaning that you have $250,000 in equity. Well, instead of selling the home to get the money, you can simply do a refinance or a HELOC, which would allow you to capture some of that $250,000 completely tax-free. Now, when it comes to stocks or funds, you can do things like pledged assets, margin loans, or portfolio loans, where you would be able to get a percentage of the overall portfolio that you have, typically up to 35% of your overall portfolio value, and you'd be able to get a loan for just a few percent interest as opposed to paying short-term or long-term capital gains on the sale of your stock or your fund. So once again, the idea is that instead of selling to live off of that money, you simply get a loan and you live off of the loan. And the reason why it's important to have assets that appreciate over time is because even though you're living on the interest, as that asset continues to appreciate more value, if you need more money, you just take out another loan against your asset. So the final step in the buy, borrow, die strategy is die. And so the idea of this is when you pass away, oftentimes your beneficiaries or your heirs are going to be the ones that inherit your portfolio, your real estate, and things like that. Now, if you do this correctly, your heirs or beneficiaries could essentially take over your assets and pay no taxes, whether they continue to borrow against those assets or they sell it off right away. So like, let's say in stocks, let's say that you had bought an SP 500 index fund. Let's say your cost basis was $1,000. And let's say when you passed away, that cost basis was now $10,000. Well, when that fund is inherited by your heirs or your beneficiaries, what happens is that if they sell that right away at $10,000 per share, they won't pay any taxes whatsoever because they inherited it at what's called a step up or at cost basis. Now, if they wanted to, they could continue to borrow against this asset and just continue the trend of what you were doing during your whole lifetime. Real estate's the same thing. Let's say that you buy an asset at $500,000 and by the time you pass away, that asset is now worth $2 million. Well, your heirs or beneficiaries could simply sell off that home right after you pass away and would pay zero taxes on that $2 million because once again, when they inherited it at a cost basis of $2 million, not the $500,000 that you paid for it. So this means that they would pay zero taxes on that $2 million, or they could continue to borrow against that $2 million asset value. Now, there are a few things that you really want to watch out for when doing these types of things. Just because you can borrow money doesn't mean it's a good idea. So anytime you borrow money, when you refinance or you do a portfolio loan against your assets, you want to make sure that you're still cash flowing well. So in real estate, if you're going to get a loan against your property or your asset, you want to make sure that you're still cash flowing after that refinance or after that home equity line of credit. What can happen is that you borrow money, but then you cash flow negative. And if something were to happen in the market or you needed to all of a sudden pay back part of that loan, you wouldn't be able to because you're not cash flowing. Now, in terms of stocks, it's very similar. Typically, they're only gonna let you borrow up to 35%. What you don't want to have happen is a stock market crash or a turn in the market and you are no longer at that 35% portfolio loan to value. Because what will happen then is you'll get what's called a margin call. And then you'll need to be able to pay that particular amount back. You want to make sure that when you are loaning against your assets, that you're loaning against something that has very low volatility or an amount that you can pay back if needed. Now, one of the best portfolio loans I have found out there is M1 Finance. And M1 Finance lets you borrow up to 35% of your portfolio value at about 3.5%. Now, if you upgrade to the pro level of M1 Finance, it actually allows you to borrow up to 40% and only charges you 2% loans. So this is phenomenal. So instead of selling stock and having to pay short-term gains of 10, 20, 30, 40+%, you can simply borrow against your portfolio for as little as 2%, use that extra money to reinvest or use that money the way you want, and you can pay back any time. So I highly suggest you check out M1 Finance if you're looking at doing a portfolio loan against your stocks. But anyways, that is the buy, borrow, die strategy. This is how the 1% continue to build wealth by avoiding tax payments. If you like this video, please be sure to smash the like button, hit the subscribe button as well, and the little notification bell. If you want more videos on personal finance, investing, entrepreneurship, living life on your terms, this is the channel for you. But let's go out there and let's build that dream.